Thank you very much, everyone, for returning so promptly. Hugely appreciative of that. We have an exciting set of discussions as we move into the second part of the international conference. And I think given the discussions that we've had in the first part, it's fantastic to start with a panel looking at the future trends in international trade and investment, something very strongly that came up in the work that Freshfields has launched today and in all of the discussions we've had so far. Could you welcome, therefore, to the stage the chair of the panel, the chairman of Policy and Resources at the City of London Corporation and the deputy chair of the TheCityUK board, Chris Hayward.
Miles, very much indeed, and good morning, ladies and gentlemen. And without any further ado, although I'm going to say a few words of introduction to this panel session, could you please also put your hands together for the very talented and stellar panel, who I'll invite them to join me on stage now as well. So, ladies and gentlemen, good morning to you once again. Welcome back. I hope you've all had a refreshing coffee break, and thank you, all of you, for joining us at today's TheCityUK International Conference. As I say, I'm delighted we've got a stellar panel to begin this session, where we'll be discussing the future trends in international trade and investment. And we'll hear from four leading voices in global trade and investment, who I'll introduce to you shortly, on some of the current challenges and the opportunities for 2023. Miles has already introduced me, so I won't repeat who I am, but let me say I'm delighted to have the privilege of chairing this session this morning. Now, ladies and gentlemen, as countries around the world recover from the impact of the global pandemic, new macroeconomic and geopolitical challenges have emerged. From Russia's illegal invasion of Ukraine to the household cost of living crises, questions over globalization and economic inertia, international trade and investment is facing new and ever more complex conditions. And securing long-term growth and meeting global challenges, including, of course, the drive to net zero, rely on the ability to adapt and to innovate. And here in the Square Mile, our continued development and success is contingent on our capacity to change, to build bonds, and to create trust so that trade can thrive. And at the City of London Corporation, we have brought together the financial and professional services industry to launch our Finance for Growth strategy and working party, which will be a roadmap. It's a project which will identify ways to bolster UK FPS and help identify and tackle some of the challenges our sector faces. In short, our aim is to set out a long-term plan to reinforce and renew the UK's role as a global financial centre. We will report back on the sector-driven review in the autumn, in time for the various party conferences, and we will make recommendations for regulatory reform in the UK, FPS, and focusing on 4 chapters: tech and innovation, sustainable finance, a competitive marketplace, and international promotion. What we want to try and do is to aim to ensure that the UK FPS sector is best in class internationally and able to contribute positively to the UK economy and global growth the rest of the decade and beyond, whoever forms the next UK government. So with that, ladies and gentlemen, growth and global trade is, of course, just one of the issues we'll discuss, but let's actually now get down to the reason we're all here, to have the discussion with our very talented panelists, and let me introduce them to you this morning. First of all, Wei Li is Managing Director and Chief Global Investment Strategist at BlackRock, responsible, I think, Wei, for developing thought leadership on tactical asset allocation and delivering actionable views across asset classes. So very warm welcome to you. My good friend Simon Manley is the United Kingdom's permanent representative to the World Trade Organization, prior to which he was Director General of the FCO HQ team providing the global response to COVID-19. Martin McElwee is a partner in Antitrust, Competition and Trade at Freshfields, Bruckhaus, Deringer, and has been involved in a wide range of cases in front of the European Commission and the UK competition and sectoral regulators. So thank you, Martin, for joining us too. And finally, on the end, last but not least, Ayuna Nechaeva is Head of Europe Primary Markets, London Stock Exchange Group, co-chair of LSEG's Women Inspired Network UK chapter, and chair of the TheCityUK's EMEA Market Advisory Group. So, ladies and gentlemen, this session now this morning will feature on 2 rounds of questions from me as chair to our panellists before turning to all of you for audience questions. So if you want to, please submit those through the event app. I can pick them up here in front of me, and I can call you at the appropriate time. If you don't want to do that and you're here present, of course, please raise your hand at the time, and we'll try and get as many of your questions to the panellists in as possible. So our first round of questions, panellists, this morning focus on the current state of affairs, global headwinds and their impacts. Russia's invasion of Ukraine, which I mentioned a moment ago, the battle for tech supremacy, the cost of living crisis, deglobalization, these are all huge challenges which we are facing as a nation. So I'm going to start with Ayuna first of all, and then come to you, Wei, and actually ask you both the same question, which is how have shifts in the flows of goods, supply chain disruptions, and global geopolitical tensions impacted trade, finance, and investment? Can I start with you, Ayuna?
Great, thank you. We have had a chat with Wei, and actually we wanted Wei to start first, and then I'll continue. But actually,
I don't mind. Really, in which case, let Wei go first.
Yes.
All right.
I'm happy either way. Hi there. Good morning. Thanks for having me. Very happy to be here. So thinking about kind of the broader macro environment and how it has been impacted by events recently, I think it's important to have a bit of a delineation between the cyclical, tactical forces as well as the structural forces. So in terms of the cyclical forces, we are coming out of the pandemic, and the ongoing tragic war in Ukraine is still taking place, and there is asserting supply constraint to the broader economy, and there is also a certain pressure on inflationary dynamics as well. So there is the cyclical piece of the equation. And then I would make the observation that oftentimes too much attention is being paid to, are we going to have the next rate hike by the Fed? Are we going to have a recession this cycle? And not enough attention is being paid to the structural big paradigm shifts that are taking place in the economy. So on the structural side, I think it's really important to understand we're going through a regime change from our perspective. So we have, you talked about the net zero transition. I think you used the word deglobalization or rewiring of globalization, as well as demographic trends. And those are trends that when we hear structural, we think that they take a long time to play out and we don't have to worry about that now. But actually, those are trends that have been accelerated, that are impacting the market, that are impacting the economy as we speak, and we have to care about them too. So all of a sudden, we're talking about kind of the interplay between the cyclical forces as well as the structural forces, and understand how they interact with each other and understand what that means for the economy and inflation is really important. Now, let me take a step back, bring all of that together and venture to say that we have left behind a period of great moderation that was really the last 40 years, that was characterized by low macro volatility, reasonably low market volatility, And we have now entered a new regime of higher macro volatility. Let me explain why I say that, and all the while having a bit of a perspective from a structural angle, because not enough attention is being paid to structural forces in my view. So if you think about the Great Moderation, the period from mid-80s to before the pandemic, this was a period that was blessed by steadily increasing global production capacity. You know, like we had wonderful developments globally thanks to the peace dividend, thanks to the demographic tailwind, thanks to globalization, thanks to China joining WTO. Because of that, this was really a period where actually production capacity was not so much of a constraint as we go through economic cycle. And what that means is that economic cycles were then caused and driven by demand side of the equation rather than supply side of the equation, because supply constraint was not really a constraint because production capacity was steadily going higher. And when things were driven by demand side of the equation, I would say that the role of central banks and the job of a central banker was easier, right? Because their tools were designed to work on the demand side of the equation. So during those periods where economic cycles were driven by demand factors, central banks were able to quickly mitigate some of those factors. You know, if we had overheating of demand and spending, then they hike rates to dampen demand, and then you mitigate the cycle, and vice versa. If we had collapse in demand leading to recession, then they cut rates to stimulate demand, and cycles were readily mitigated. But now we're in an environment, again, going back to the structural forces that I talked about, labor shortage, aging demographics, geopolitical fragmentation, and also the net zero transition, which is ultimately a series of supply shocks. We're now in an environment that cycles are driven by supply side of the equation. Supply side of the equation, global trade challenges, and what that means in terms of the undercurrents coming from geopolitical side. When cycles are driven by supply side of the equation, it's harder for central banks to mitigate the cycles because their tools are really designed for the demand side of the equation. So yes, of course, they can still aggressively hike rates, and that's what they have been doing the last 18 months or so. But the cost of fighting inflation when inflation is driven by supply is a lot higher in this environment compared with the cost of fighting inflation when inflation was driven by demand. So they have been hiking rates aggressively, but as a result of the tougher trade-offs facing them, we think that recession is unavoidable if you want to bring down inflation. And we also think that in response to the tightest and the fastest rate hike cycle since the 80s, we're going to see financial cracks appearing. Arguably, the September episode with the gilts market last year, as well as the banking turmoil this year in March, are expressions of these financial cracks that inevitably will come as a result of the tightening broader environment. It's hard to say what the next crack would be, but it's reasonable to assume that when you tighten this quickly, something could break, right? So this is the overall framing. I think the world has changed, the regime has changed. We have gone from a world shaped by demand to a world shaped by supply. The role of central banks have become more important, but also their job has become a lot tougher. And when that comes to investing, I think it's just fair to say that we have to be more cognizant of the sort of outcomes that are possible that we should expect. Because during the Great Moderation, we had multi-decade bull markets in both equities and bonds happening alongside each other. We took it for granted because we're like, oh no, this is, it happens, it's wonderful. But actually that's very, very rare. Most of the time it's either or, right? So depending on what central banks do, they either fight inflation at all costs, and in so doing, hurt the economy, hurt equities, or they say, look, we live with a bit more inflation because it's supply driven. We can't fight it as effectively. The UK inflation is still double digit. Who would expect that at this point? But then when they live with inflation premium needs to go higher, and term premium needs to go higher, and bonds would suffer. So all of a sudden, we're talking about not joint bull markets anymore. We're not talking about Goldilocks investment outcome anymore. We're talking about choosing between equities and bonds, depending on what central banks do. And that makes asset allocation so much more important. It needs to be a lot more dynamic. And by our research, the cost of sitting on a static allocation and let it drift is 3 times higher now compared to the cost during the old regime, when doesn't matter if you're 60-40 or 20-80 or 80-20, as long as you were invested, everything was going up and then you will benefit, right? So this is why we say, as we evaluate the interplay between tactical forces and structural forces and thinking about what that means for the investment regime, the macro regime, we think that the times have completely changed and it requires a new playbook.
Wei, thank you very much indeed. Ayuna, what would you like to add to that?
Thank you, and fantastic summary, Wei. Just to narrow the focus down a little bit to the EMEA where I sit. So the 2021 actually was one of the biggest years for fundraising in London overall. And you know, there were a huge number of IPOs, including international. And that was a result of the delayed demand from the pandemic. And then when the war in Ukraine hit, 2022, it effectively closed the global financial markets, not just in the UK, but globally, for businesses. All but very few came through the market. And there was a massive outflow from equities into safer assets, to what Wei has alluded. And what we were kind of expecting for this year is that recovery again. But of course, the world has changed, and it has changed permanently. We're no longer in the bull market, and the risk appetite has changed, but also the asset allocation. So what we're seeing right now is in January, the markets have sort of sprung up. Companies started preparing to go public across the globe, in the UK as well. International companies also. But then the SVB, the Silicon Valley Bank collapsed. The Credit Suisse was taken over by UBS. So that sort of, we say, half-closed markets, but we're seeing the recovery again. But more broadly, the war in Ukraine actually had a massive impact on the neighboring countries. So I just will talk a little bit about this. Apart from the refugee crisis, which impacted Poland, Romania, you know, the Baltics, where Georgia and Kazakhstan as well, where you're seeing a big flows of refugees, but also Russians fleeing their own regime, going to those countries. So that, of course, puts a strain on the economies there. In addition, of course, the same supply constraints, the same inflationary pressures that are faced by these companies and by these countries. But also, don't forget, a lot of those businesses did have trade with Russia, so that had to be unwound, and that also had a further impact. Why it's important? It's important because those regions, Eastern Europe, was really a place where investors looked for growth. So the growth rates and the forecasts were much higher than in developed Europe. And then now again, we were seeing that that region is struggling a little bit too. And then in the Middle East, you're seeing that the Middle East throughout 2022 actually was one of the most active markets. So thanks to their own capital that sits within the region. So UAE, Saudi Arabia, and you're seeing that companies flock to their local markets and raise capital there. There was an international proportion, but local money played a big role. And just to conclude, we, in terms of what's happening right now, it seems like markets are recovering a little bit. So FTSE 100 was the best performing index last year. You would be surprised, reading the news, you wouldn't tell, but actually it was positive, better than the US indexes and so on, mainly thanks to 70% of its revenues being from abroad. But then it's now doing well. Tech valuations are recovering as well. So we're seeing S&P 500 also recovering, and the energy prices are still on the positive trajectory. So gold, natural resources are doing good. So we're not going to see this massive bull run or like the the really favorable conditions that we've had in the past 10 years or so. But I think I'm also, like previous speakers, cautiously positive.
Thank you both very much. Martin, perhaps I can turn to you now and ask you, how are businesses navigating the challenging global trade environment? What are they doing to both mitigate risks and indeed to maximise opportunities?
So I think what we see is clients seeking out pockets of relative certainty amidst so much uncertainty, little clearings of certainty in the forest of uncertainty. And those areas of relative certainty, I think, are very aligned with some of the other messages we've heard this morning. So, for example, what we can be pretty certain of, as I think everyone in this panel would agree, is that there will be a continuing significant degree of investment in the green revolution going forwards. What I'd like to think is that that can then get a degree of policy and regulatory support that maximises that investment potential. In the UK, we've moved the goalposts quite a number of times, I think, in terms of our commitment to that, the sectors that we're focusing on, the types of infrastructure project that we are focusing on. Similarly, in Europe, the Green Deal's been there for 2019, but we see quite a shift in policy, in particular with the turning on of state aid taps in a way that was inconceivable, I think, a few years back. So there has been continuing policy change in this area at a time when I think investors would welcome a degree of stability and commitment. Similarly, in digital, again, undoubtedly an area where there will be continued opportunity, but again, very important that there is a stable policy environment to do that. For example, it is critical that the UK continues to maintain its privacy alignment with Europe and doesn't suffer from the disease of change for change's sake in relation to GDPR equivalence. So there is still plenty of M&A going on out there, plenty of investment. We are still seeing in multiple jurisdictions locally created headwinds that do not maximise that. So just in the context of investment, there was a good paper, I thought, by the Tony Blair Institute this week on our National Security and Investment Act and how that could be improved to give greater certainty to businesses when they are investing in the UK, particularly around transparency in that regime. We've seen a great deal of uncertainty in merger control regimes worldwide over the past few years, not just in the UK, but very much in the US now, with the FTC and DOJ led by Lena Khan, Jonathan Cantor, changing the paradigm for merger control. In the UK, similarly, we see the CMA broadening the types of case that it wants to look at, looking at more exotic theories of harm. That doesn't lead to certainty for businesses that want to invest in the UK or in the US, respectively. And a period in which we take stock and try to deliver that certainty, when there are so many things that are frankly outside our control that we just talked about that are delivering uncertainty, I think would make a big difference.
Thank you very much indeed, Martin. Simon, let's turn to you now. I mean, I mentioned in my introduction that you are our permanent representative to the WTO. I wonder, how do international organisations, including the WTO, respond to these challenges? I mean, more broadly, do these threaten the liberal economic model? And if so, how?
So, I mean, I think if you look at, well, first of all, it's great to be here, Chris. Thanks very much. Lovely to be back in the city. Lovely to be here with all of you. So I think if you look, first of all, at the kind of the Russian aggression against Ukraine, I think the multilateral system has done rather well and counter to some expectations. And the Russian aggression is many things, but it is fundamentally an attack on international law and the international order. And I think the multilateral system has responded well to that, including the WTO. And I was sat in the WTO the morning of the Russian invasion, and we had just decided the new dates for a WTO ministerial at our third attempt. And there was a sort of fear of, like, my God, we can't possibly do anything. The ministerial is kind of going to fall away again. And it didn't. And actually we had probably one of the most significant ministerial meetings of the WTO for a generation, including a groundbreaking agreement on environmental aspects, fisheries subsidies. First time the WTO had ever done that. So I think overall, the multilateral system has responded well. Russia has been isolated, whether it be the United Nations or across the whole plethora of organizations we have in Geneva. They've lost leadership positions right across the board. My Russian oppo keeps a low profile as a result of all this. But there are, as Wei said, you've got both the tactical and the structural. And I think where we would say that the system, the multilateral system, still has to go further and faster is on those structural issues. And that includes, by the way, the WTO. That means we have to do better at responding to the climate crisis. We have to do better at marshalling the potential of digitalization for global trade. So we saw at the recent spring meetings of the bank and the fund in Washington, important steps in terms of upscaling the financing for climate and for the least developed countries, in which the UK played a really big role, I think, releasing another $5.5 billion US dollars for some of the most climate risk dependent countries in the world and for least developing countries. But we need to go further in terms of marshalling that finance to enable that transition to net zero. And in terms of the WTO, WTO head, Director General, Dr. Ngozi, speaks often of the need for trade to be more green, more services, more inclusive, more digital. And I think we'd absolutely endorse that. And that is about, I think, trying to enable those structural changes to the global economy in a way that actually increases opportunities for developed countries to actually exploit the potential of both digital and of the greening of the global economy. And I think there's a real role, if I may say, Chris, for people here in this room to help us in that process, to be voices in favour of arguing that there are real potential gains for developing countries out of these structural changes in the global economy, as long as we can enable those structural changes in a way that actually maximises the potential for developing countries.
Thank you very much for that. Panel, thanks for that round of questions. I mean, we've been talking about the problems in that round effectively. So now let's turn to maybe solutions and opportunities, the way forward, so that we can try and explore what we can do maybe this year. Martin, let me start with you on this one. Today, the TheCityUK partnership with Freshfields have launched an investment report. This report provides recommendations to the UK to enhance its investment proposition. What are modern asks for our industry to encourage international investment and trade?
So, well, I think I'm going to be the second optimistic Scotsman in one morning, which might be some sort of new record. Because there is a lot that can be done, and a lot that can be done relatively easily and without expectation of very significant government spending. In preparation of our report, we spoke to a lot of Freshfields clients and TheCityUK members. And the message from them was very much not an old mantra of we need low tax and low regulation. There is a recognition that a taxation system that is fair and proportionate is necessary to support good infrastructure, good skills. There's a recognition that many of the public policy goods that are supported by regulation are the right ones. What we heard was much more of an ask for a modern approach to investment in the UK and investment policy for the UK. So to take a few examples, the ask was very clearly for a mainstreaming of the green agenda. I mean, Ian Stewart said this morning, HSBC is all in. Freshfields is all in. Is the government all in? Does it recognise the need to be all in, that green is going to be part of not just the agenda of one particular government department, but of all government departments? And it needs to inform policy priorities, investment horizons, everywhere from the Treasury through to the Department for Business and Trade, Department of the Environment. It's not a single government department issue. Second, a request, and this goes back to what I said earlier, for more efficient and more stable regulation. Not less regulation, but regulation that is well administered. For example, the concern about the FCA authorization regime that just leads to delay and uncertainty, concerns about merger control, where the proliferation of theories of harm and jurisdictional capture make it very difficult to do deals. Regulatory stability more than less regulation. Third, and again to go back to the point I mentioned earlier, regimes that seek to control investment in the UK that are transparent, predictable, like NS&I, no more missteps like the National Security Bill that looked as if it was going to cause enormous headache for very little gain. And finally, mobility and flexibility. No more old-fashioned chafing at the idea that it is right that some people will work remotely and will not be in the office every day. A recognition that working across borders is something that needs government support, making visa facilitation easier, making greater labour mobility into and out of the UK with our partner jurisdictions much easier. So if you join that up, I think with an approach across government to trade promotion that is joined up between departments, you can make quite a big difference in a way that is not driven by government spending, but does unlock significant opportunities. And that's why I think I can be optimistic about where we can go in the future.
Thanks very much indeed for that, Martin. Wei, let me turn to you now. We covered a number of challenges to international trade today. Where do you see the new opportunities? You know, what are the future trends in commercial investments?
I'm going to structure my remarks in three directions. First, a bit more tactical, what's happening right now. And the second 2 points I want to make are more structural in nature and related to the discussions that we just had as well. But in terms of what we find exciting right now, if you think about last year, it was a very difficult year for markets because equities were down and bonds were down and it was bear market across the board and central banks were hiking rates aggressively. But if there is one silver lining that came out of last year is that income is finally back in fixed income, right? We're getting paid close to 5% sitting in treasury bill without taking much credit risk or duration risk. And then if you compare that with the return target of many portfolios of our clients that is somewhere between mid to high single digit, you achieve most of that without taking much risk sitting in a front end of the government bond market. Why wouldn't you do that, right? So all of a sudden, it's becoming exciting again to think about income in the context of fixed income investing. So that's exciting. We like bonds over equities at this point because if you look at what markets are pricing in, especially in developed market equities, is pricing in earnings growth to still be somewhere between low and mid single digit when we see us heading into a recession. So there's a bit of a disconnect that I am somewhat concerned about. And also markets are pricing in central banks to be able to cut rates, to come to the rescue of the economy, applying an old recession playbook. But we just talked about we're in a new regime, inflation is going to be more persistent, or at least the core service shelter parts of inflation is going to be more persistent. So central banks can't cut rates this year. Markets are hoping that it would be able to cut rates, and that disconnect gives me a bit more concern about kind of equities across the board, but selective opportunities remain. But then the point about kind of broader asset allocation at this juncture tactically is that I find emerging markets in a better position right now because emerging markets are going through a slightly different phase when it comes to central bank policy. They started hiking rates earlier. They started hiking rates first compared with developed market to the extent that now they can start cut rate, right? Like PBOC, People's Bank of China already cut rate earlier this year. So they are going through a different kind of dynamics, and the restart of China, strong momentum. We're expecting 6 handle in terms of growth for this year. That is quite different versus the growth slowdown and recession that we see in developed economy, which is why currently at this juncture we have a preference for emerging market over developed market. So that's the tactical point I want to leave you with. In terms of the structural point, one thing that we talked about already, this green transition, the structural opportunities that come out of that, it's super exciting. We're talking about hundreds of billions of dollars going into green investment that is likely also going to crowd in private sector investment as well. In the US, we have the Inflation Reduction Act that prioritizes the domestic production of renewable energy, and we had the equivalent response coming from Europe as well earlier in the year. Europe already had a plan, but now it's going to also think about kind of the domestic aspect of that plan. And I would say the race is wide open, right? Like it's not just Europe and US, Canada, China, they're all in this race. So I think there are very exciting opportunities, structural in nature. And if you think about last year being a year where energy has done well, people are saying, well, does that put a pause button to the green transition? Not at all. It accelerates it because everything was happening in the context of energy supply constraint. So we see opportunities in renewable energies that did very, very well last year alongside energy. Nobody talks about it because all the focus is on oil and energy, but renewable energies did really well, right? So both energy types are doing well in the context of supply constraint, and that's what we expect as well. So there are huge opportunities there, infrastructure projects, not enough of them and too much dollar chasing after them. So we like that. So that's the structural comment I want to make, point number one. And then the second structural point I want to leave you with is we talked about kind of trade development in the context of geopolitical fragmentation. I would say that we have also entered a new regime when it comes to geopolitics, in that in the past, geopolitical events were very much driven by economic considerations. Right, like it's one of the strategies that's used to work in the great geopolitical moderation is that if something happens in market, you buy the dip because then markets always manage to swiftly recover. But I think now we're in a different environment where geopolitical outcome are driving economic outcome. So the relationships have swapped, and geopolitical factors are very, very much what they are significant, and they are asserting pressures in terms of how we think about portfolio construction by way of more persistent geopolitical risk premium. Now, when you look at markets so far year to date, you could be forgiven in saying that, well, actually, equities are not so much taking into consideration of the geopolitical developments that we're seeing, but broader markets can only take attention, like pay attention to or pay attention to one thing at a time. And right now, that thing is inflation. But already digging under the hood, we're seeing markets reacting to these developments, right? Like we're talking about gold up 10% on the year. We're talking about oil price going up 20% since the March low after the OPEC plus production cut. So in our framing, we think increasingly we cannot just fade geopolitical risk premium spike. We need to build in, as we think about portfolio construction, persistent geopolitical risk premium. And the last thing I would say about kind of the geopolitical development is that there was an article over the weekend from The Economist, which I find very, very interesting. It referenced this term transactional 25. Which is these 25 countries that are trying to strike a balance between relationships with US and China, right? We're talking about transactional 25 countries, very, very different in terms of wealth, in terms of size, in terms of political system, but they all try to strike the balance. You can call them non-aligned, you can call them multi-aligned, but these are the countries that are so far delicately trying to cater to both, and we think that China and the US will both try to win them over, and in so doing, create opportunities from an investment perspective. So when we think about geopolitical risk premium staying elevated, it's not all bad for markets. We just have to be more cognizant of the structural winds changing and not apply the old playbook when we think about navigating the new market environment.
Thank you very much indeed. Very, very interesting. Simon, how do you see the WTO evolving to address future challenges in international trade. Now, how can the UK leverage position to facilitate this process?
So, I mean, the first thing I'll say is what the WTO already provides, I hope, is really important for business, which is a kind of a rule book which we recognise and understand underpins global trade flows. But what I'd like to see it doing, as I said, is to do more to enable these structural changes to the global economy in ways that are positive for the global economy, and in particular open up fresh opportunities for developed countries so that we can have a green transition that is also a sustainable and inclusive and equitable transition. And that's where the WTO can really play a role, kind of providing, when we do a lot of events with business in Geneva, and what I hear is business saying, as different countries, as different regions try and structure their regulatory response to net zero, we need you to help us navigate this and to help us provide common standards, common rules, so that we can ensure this works for all of us. And secondly, I think in the area of digital, there's a real opportunity here to use the WTO to help simplify the rules for digital trade across the world. We've got a really important e-commerce initiative, which we're a part, along with 90 other countries. We have domestic services regulation, which could, when it enters into force, save $150 billion from global trading costs. These are really important initiatives that we need to be supporting, not just as government, but as business, so that we can ensure that these structural changes to the global economy are ones that actually open up opportunities for countries, rich and poor, large and small.
Thank you very much indeed. Ayuna, the last question formally is to you. We're running a bit out of time, but I'm keen to get a couple of questions in as well before we close, if we can. Could you just say what you think the role of London's financial services in fostering international trade via the London Stock Exchange? How can we bring more international startups to London and maintain our international competitiveness?
Thank you, Chris. So I would like to share some good news with you. Despite what, again, we have been seeing in the press, we welcomed 3 IPOs in 1 week earlier this month. And actually, we've had listings from the US by a US software company, which is incorporated in Delaware. We had a reverse takeover from a German company, which I hosted actually earlier this week. And also a listing of a renewable energy business from Poland, which actually has a pan-European operation. So the interest in London and London's capital markets remains at a very good level. But of course, we just must make London more welcoming to international companies. Why is it important? Of course, when an international company seeks a London IPO, this taps not just the London Stock Exchange or investors, actually the whole cohort of investment banks, law firms, audit firms, insurance companies that get involved, and then of course sharing the UK expertise with those international companies for them to become up to speed and up to the standard that UK-based investors expect from them in terms of corporate governance, compliance, risk management, and all of that. So that's hugely important. And I'll share with you some of the developments that are happening to make London a better and more welcoming market for companies from the UK, but also abroad. So the London Stock Exchange, together with leading institutional investment funds and asset owners, and under the aegis of the HM Treasury, has set up a CMIT, Capital Markets Industry Task Force, which is chaired by the London Stock Exchange CEO, Julia Hoggett. And it actually makes a number of recommendations to the HM Treasury on what needs to be done to unlock the potential of the UK even further. That involves regulatory changes. And some of those proposed changes were also reflected in FCA's CEO Nikhil Rathi's speech earlier this month, but also recommendations on things like unlocking pension capital for higher risk investments. So a couple of panelists today have referenced that, how important it is to start investing in higher risk growth companies. And that actually is connected to also supporting earlier stage businesses in the UK. These recommendations also look at providing incentives for UK pension capital to be invested in UK listed companies, It's actually not always the case. So a lot of the, and Wei would know, a lot of the asset allocation also goes into overseas companies, not the UK companies. So that's going to be the development in the next year or so. And just to finish off, you've all heard about the Hill review and the regular changes that have already taken place. And the Edinburgh reform was referenced as well. So that's ongoing focus for the next few months. But I feel like together with the commitment to sustainability and ESG, together with commitment to diversity and inclusion, and the commitment to supporting higher risk UK companies and international companies, we will be in a good place.
Thank you. Panel, thank you very much indeed. I'm determined just to get a couple of very quick questions in, so very, very short answers, and only one member of the panel can, and it's the first one with the hand up, can answer the question as far as I'm concerned. So Jennifer Green asks, what's the single most important thing that the international industry can do to reduce barriers to investment? Who wants to take that one? Ah, right. Somebody jump in and give a short answer. All right, no, we'll move on to the other question. Another question then, all right? Because I've run out of time almost. Okay.
Supportive regulatory framework and more carrots, less sticks.
More carrots, less sticks.
Yeah.
Okay, great, good short answer. Thank you very much indeed. Angus Canvin asks, ask the panel's thoughts on prospects to increase financial services exports from the UK, in particular to large markets like the EU and USA. Who wants to grab that one? You're nodding. Do you want to grab that one, Ayuna?
Yes, and actually I also came up with a very short answer to the previous question.
Ah.
Yes, very similar, changing the cultural mindset to celebrate wins, not just criticize failures. But for the financial service is the biggest export abroad from the UK. So we do need to come together and work together with the FCDO, with the Mansion House, and also among us professionals to really have a coherent view and work together to export, to boost this export of knowledge and know-how into the EU. I think Brexit as a problem is fading already. So I think we're at the next stage where we can start having starting to have more productive conversations.
Super, thank you very much. Well, ladies and gentlemen, we have run out of time, I'm afraid, but I hope you agree with me. It's been an absolutely excellent discussion. And please do put your hands together and thank my fantastic panel. Thank you very much indeed. Well done. Thank you.
And could I echo the thanks to the panel and to Chris. I think that was a absolutely terrific discussion. And I'm delighted that we have, in the course of the morning, already invented a new TheCityUK index, the Optimistic Scotsman Index, which is at record highs, it would appear, and something to build on. So, and to continue that note of optimism is, I think, going to be the task for all of us as we go on.